The foreign exchange market, or Forex for short, boasts a fascinating history stretching back centuries. From its roots in facilitating international trade, it has blossomed into the world's largest financial marketplace. But how exactly does this colossal market function? Grasping the mechanics of the Forex market is vital for any aspiring trader. It's like learning the rules of the game before you jump in. Understanding the inner workings of Forex will give you a solid foundation for success. In this video, we'll unveil the mysteries of Forex mechanics. We'll dissect key concepts like currency pairs, order types, and leverage, painting a clear picture of how trades are executed and sold. So whether you are a total newcomer or seeking a refresher, stay tuned. We are about to embark on a captivating journey into the world of Forex mechanics. This brings us to the core concept of Forex market, currency pairs. Each trade involves buying one currency and simultaneously selling another. The first currency listed in the pair is called the base currency, and the second is called the quote currency. For example, in EUR USD pair, euro is the base currency and US dollar is the quote currency. So when you buy euro USD or EUR USD, you're essentially buying euros and selling dollars, hoping euro will strengthen against the dollar. Now, not all currencies are created equal. The Forex market features three main categories. The major currency pairs. These are the most actively trading pairs, typically involving US dollar, as US dollar is the reserve currency of the world, and it's paired with major economies like euro, which is eurozone or their currency euro, or Japanese yen JPY, British pound GBP, Swiss franc CHF, and Australian dollar AUD. These pairs often offer high liquidity, meaning there are always plenty of buyers and sellers, making it easier to enter and exit trades. So now let's look at minor pairs. These are the pairs involving currencies from smaller economies with less stable political or economic conditions. For example, New Zealand dollar (NZD), South African rand, it's called ZAR, or Turkish lira TRY. They offer slightly higher volatility, which can present both higher potential returns and risks for traders. So now let's talk a little about exotic currency pairs. These pairs involve currencies from less developed nations or those with restricted exchange rates. For example, Mexican peso, the Thai baht, Hungarian forint. They offer highest volatility but also come with the most significant risk due to their low liquidity and potential for unpredictable price movements. But who exactly participates in this giant currency exchange? Well, the Forex market is a global playground with a diverse range of players. Here are some of the key participants. Number one, the commercial banks. They are the biggest players, constantly exchanging currencies for trade finance, international payments, and managing their own investment. Central banks. They influence the markets by setting interest rates and intervening through buying or selling of their respective currencies. Then we have hedge funds and investment firms. They trade currencies to maximize returns for their investors, often taking advantage of short-term market movements. Last and not the least are the retail traders, folks like you and I. That's you and I again. With the advent of online platforms, individual traders like you and I can now participate in the Forex market, buying and selling currencies based on our own analysis and strategies. Understanding currencies pairs and their major players involved goes in a long way in demystifying the Forex market. In the next segment, we'll delve deeper into the mechanics of placing trades, exploring different order types, and concept of leverage. Now that we have grasped the concept of currency pairs and the market participants, let's explore the virtual battlefield where these trades take place, the Forex trading platform. Imagine it as your mission control center where you can monitor markets, analyze trends, and execute your trades. There are many platforms available, but the most share some of these basic functionalities. Think of the platform as a hub with several different key areas. The first is the market watch. This section displays quotes, or prices for various currency pairs. You can customize it to show your preferred pairs and view their real-time bid and ask prices. Now, what is a bid price? Bid price is the highest price a buyer is currently willing to pay for a particular currency pair. Ask price is the lowest price seller is willing to accept for the same pair. So it's a buyer and seller. Buyer is bidding, seller is asking, and intersection of the two is called the trade. The difference of the two prices is called the spread, which essentially represents the platform's commission for facilitating your trade. But how do we measure profits and losses? Here is where pips come into play. A pip stands for percentage in point, and it is the smallest increment of price movement for a currency pair. For the most major pair, 1 pip equals 0.0001. So 3 zeros and then 1. That is 1/10 of a cent. A cent is 1/100th of a dollar, and pip is 1/10 of a cent. So, in other words, a pip is 1,000th of a dollar, just to give you a rough idea in the quote currency. So, if EU or USD price moves from, say, 1.2000 to 1.2001, that's a gain of 1 pip. I hope you understand that. Understanding pips is crucial because they allow you to track your profits and losses with precision. Most platforms display the current price change for each pair in pips alongside the bid and ask prices. Now, keep in mind that some platforms may display pip value differently for certain exotic currency pairs. Always check your chosen platform for its specific pips calculations. So now, by utilizing MarketWatch and understanding pip values, you can effectively monitor price movements and identify potential trading opportunities. In the next segment, we'll dive deeper into how you can actually place trades, exploring different order types and concept of leverage. Now that you're familiar with the trading platform and how to track price movements, let's explore the tools at your disposal for actually entering and exit trades. This is where understanding different order types becomes crucial. These orders essentially tell the platform how and when you want to buy or sell a currency pair. So let's talk about the most common order types, and the most common one being market orders. This is the simplest and the most straightforward one. When you place a market order, you are essentially telling the platform to execute your trade as the best available price at that very moment. Market orders are ideal if you want immediate execution, but the price you get might not be exactly you envisioned due to bid-ask spread. Limit orders. So these offer you a bit more control. You specify the exact price at which you want to buy or sell a currency pair. With a buy limit order, your trade will only be executed if the price falls to your desired level or lower. Conversely, a sell order will only be filled if the price rises to your specified level or higher. Limit orders are ideal for entering trades at specific price points, but there are no guarantee your order will be filled, especially in the volatile markets. So let's talk about stop loss orders. These are crucial for managing risk. You set a price below the current market price for a buy trade or above for a sell trade. If the market moves against your position and reaches your stop loss level, the order will automatically close. So it'll limit your potential losses. So take profit orders. Similar to stop loss orders, these help to lock in profits. You set a price above the current market price for buy trade or below for a sell trade. If the market moves in your favor and reaches your take profit level, the order automatically triggers, closing your position and securing your profits. Now, there is an additional concept that significantly impacts your trading experience, and it's called leverage. Forex trading platforms allow you to control a larger position than your account balance by borrowing money from the broker. This can magnify your potential profits, but it also amplifies your potential losses. For example, with 100 to 1 leverage, you can control a position worth 10,000 with only $100 of your own money. If market moves in your favor, you can make significant returns on a relatively small investment. However, if move against you can quickly wipe out your initial investment and even lead to owing the broker additional funds. Leverage is a powerful tool, but it comes with significant risks. Always use it cautiously and ensure you understand the potential consequences before applying it to your trades. So, by mastering these order types and approaching leverage with caution, you will be well equipped to navigate the Forex market with greater control and discipline. In the next segment, we'll discuss how trades are actually executed and settled, providing a comprehensive understanding of the entire process. Now that we have explored order types and the concept of leverage, let's delve into the final steps of a trading process: execution and settlement. So you've decided on a currency pair, analyze the market, and place your order using the platform. Here is what happens next: electronic execution. So when you click buy or sell on your order, it is transmitted electronically to the platform's matching engine. So that engine instantly searches for a counterpart a trader willing to take the opposite side of your trade. If a matching order is found, the trade is executed at the agreed upon price. So margin and margin calls. So it's really important for us to understand margins. Remember leverage, it comes into play here. When you use leverage, you are essentially borrowing money from the broker to control a larger position. The minimum amount you need to maintain your account to cover the leverage is called margin. If the market moves against you and your account equity falls below a certain threshold, broker will issue you a margin call. This essentially means that they're demanding you to deposit additional funds, or they'll close your position to meet the minimum margin requirement. So now let's talk about settlement. Unlike buying stocks or bonds, Forex trades settle within 2 business days after execution. It's called T+2. This means that the actual exchange of currencies between you and your counterparty takes place 2 days after the trade is placed. Understanding these final steps provides a holistic picture of the Forex trading process. Remember, while leverage can amplify your profits, it also magnifies potential losses. Always ensure you have sufficient margin to cover potential fluctuations and manage your risk wisely. With this knowledge under your belt now, you've successfully navigated the key mechanics of Forex markets. In future videos, we'll delve deeper into strategies, risk management techniques, and additional resources to equip you for your Forex trading journey.